Welcome once again. This is Pinnacle Professional College, and we are still on corporate governance. If you haven't watched our previous lectures on corporate governance, please do so. We've been having extensive conversations around corporate governance, and it might be very, very helpful for you to understand what corporate governance is all about. So today we've been talking a lot about shareholders and directors. So today let's delve deeper into that. Shareholders and directors. The shareholders are basically the owners of the company. The influence of the shareholders over their company varies with circumstances. In a small company, the shareholders and directors might be the same individuals. We've talked about this before. In some companies, there may be a majority shareholder. A majority shareholder is simply a controlling shareholder, a shareholder who owns more shares. A majority shareholder should be able to influence the decisions of the board of directors because he has the power to remove directors who disagree with him. So if there's a majority shareholder, that majority shareholder should be able to influence the decisions of the board of directors because he has the power to remove directors who disagree with him. In quoted companies or stock market companies, the interest of shareholders are likely to be focused on the value of their shares and the size of dividends, the value of their shares and the size of their dividends. It's very, very important. Very, very important. However, the shareholders might have little influence over the decisions of the board of directors. Now, so we've talked about the shareholders. Now, let's talk about the directors. The board of directors is a significant stakeholder group in the company because they have the power to direct the company. Directors, as the name suggests, direct. So they have the power to direct the company. The directors are basically agents for the company and represent the interests of the company. A board of directors consists of both executive and non-executive directors. Very crucial. You need to understand this distinction. Board of directors would consist of executive and non-executive directors. Executive directors have executive responsibilities. I mentioned earlier in one of our previous lectures that executive simply means day-to-day. Executive directors have executive responsibilities as managers in the company in addition to their role as director. They are usually full-time employees of the company. Non-executive directors, on the other hand, are not necessarily involved into the day-to-day business operations of the company. And sometimes they may, they would not have executive responsibilities because they are non-executive directors. Executive, as I mentioned, means day-to-day, and non-executive means not day-to-day, right? So executive directors have executive responsibilities, and they are usually full-time employees of the company. Now let's look at other internal stakeholders. We've talked extensively about shareholders and directors. There are other stakeholders as well. One key stakeholder are employees. Employees, they are very, very key. Employees can be an important internal stakeholder group. It might be possible to divide employees into subgroups, each with a different set of interests and expectations. This is very, very crucial. Very, very crucial. So employees can be an important internal stakeholder group. An important internal stakeholder group. It might be appropriate to separate senior management and other employees into two separate stakeholder groups. Why? Because senior management might have a bigger interest in profits and the share value of the company. because they might receive things like annual bonus payments, share incentive schemes, etc. So sometimes you would want to categorize employees into senior management and other employees, right? Some employees also might be able to demand large rewards from the company or might exercise strong influence because of their value to the company. Some employees are very, very valuable to companies. For example, in the UK, some individual investment bankers have a strong influence within their bank because of their specialist skills they possess and the income that they bring to the bank. So if you go to these top banks like JP Morgan, Goldman Sachs, some investment bankers have a high reputation. They have specialist skills, and they are able to bring huge amounts of revenue to the bank, right? So sometimes it might be a good idea to categorize employees. Now, we've looked at shareholders, directors, employees. Now, let's look at external stakeholders. Then, after we talk about that, we might move on to the agency theory. Lenders have an interest in the company to which they lend money, right? A lender is an external stakeholder. External stakeholders are basically stakeholders that exist outside the company. So someone who lends money to the company is an external stakeholder. So lenders have an interest in the company to which they lend money. And what's their interest? They expect that the money they've lent to the company is able to pay back their financial obligation. And one of the key things lenders would like to know is the financial performance and financial position of the company, right? Because anybody who lends another person money would want to know if they can repay them their money. It's as simple as that. Then you have suppliers. Suppliers also have an interest in a company, because suppliers would give goods to the company, right? They give goods to the company, and they expect that the company will be able to sell these goods and pay them their money back. Regulators also have an interest in companies, right? They would want to know if the company is meeting regulatory standards. It's important to know that some aspects of regulation have a major impact on the way in which a company is governed. Government also has a stake in companies. We cannot talk about external stakeholders without talking about governments. One of the things you should know is that government is interested in tax revenue. Companies are a source of tax revenue. And also companies also collect taxes for the government from both employees and customers, So companies are a source of tax revenue themselves, and they also collect taxes on behalf of government from employees and customers. For some companies, such as companies that manufacture defense equipment, the government might have an influence as a major customer for the goods that the company produces. So we've talked about lenders, we've talked about suppliers, we've talked about regulators, we've talked about governments, and we are moving now on to customers. So who are customers? Customers are basically people who buy from the company, right? And what are the customers interested in? The customers are interested in the customers are different and might have varying interests. Some customers are interested in the value that the company gives them. Some customers might be interested in the mission of the company. There are different reasons behind the purchasing decisions of customers, right? So these are examples of external stakeholders. Now, there's one theory that I've always wanted to discuss, which is called the agency theory. Now, we'll be delving deeply into this in the next lecture. But let me touch on it briefly. First of all, who is an agent? An agent is someone who acts on behalf of another. So when you hear the term football agent, it means that that person is acting on behalf of the football player, right? So an agent is basically someone who acts on behalf of another person. For example, a selling agent acts on behalf of a principal, a manufacturer of goods, to sell goods on the manufacturer's behalf. A stockbroker, for instance, is also an agent who acts on behalf of a client to buy or sell shares on the client's behalf. So a broker is basically like a middleman, an agent who helps their client to buy or sell shares. The agent must always act in the interest of the principal. It's very, very important. So that's one key thing to understand. But in our next lecture, we'll be talking more about agency theory. So stay tuned. If you haven't subscribed to this channel, please hit the subscribe button, hit the notification bell so that you receive notifications anytime I post a video. Thank you for watching, and send this to a friend. Have a good evening.